When a stock has been climbing for months, the hardest question for a trader is knowing exactly when that run is over. But there is a specific footprint left on a chart right before a major reversal, the head and shoulders top. In this video, we are going to build a complete step-by-step mathematical trading plan. You will learn how to spot this specific setup, calculate the exact price target for taking profits, and perfectly time your entry. To follow along, you only need standard charting software and a basic grasp of two things: reading daily price action and understanding volume histograms. Mastering this pattern replaces emotional guessing. Instead of wondering if a trend is exhausted, you learn to act on a verifiable, statistically reliable setup. Step 1 is identifying the formation. This chart shows a standard head and shoulders top, rising above older price data. To be valid, the proportions must be right. The center peak is highest, flanked by left and right shoulders roughly symmetrical in height and distance. Statistically, the highest performing setups occur when the left shoulder is slightly higher than the right shoulder. A lower right shoulder indicates that buyers are already losing strength early in the formation. Step 2. Understanding why. Institutions quietly acquire shares, forming the left shoulder. Retail buyers jump in late. Institutions then sell their holdings, creating the head. By the right shoulder, institutional demand is gone, and retail buyers lack capital to push the price up. The head and shoulders top is the visual footprint of institutional investors successfully transferring their shares and their risk to retail buyers. Step 3 is validation. This chart displays the volume histogram beneath the price action. A reliable setup has a specific sequence. Notice the high volume cluster under the left shoulder. Volume steps down during the head and dries up completely by the right shoulder. While declining volume is standard, historical data shows that patterns with a U-shaped volume trend, or patterns where the volume spikes highest on the head itself, result in the steepest price drops. Volume acts as the polygraph test for the setup. Trading a head and shoulders top without confirming that buyer demand is exhausted in the volume histogram leaves you vulnerable to a failed trade. Step 4 is establishing your trigger point. We do this by drawing a neckline, a straight trend line connecting the bottoms of the two troughs located directly between our three peaks. This neckline can slope up, can slope downward, or sit perfectly horizontal. Data shows that horizontal and upward sloping necklines actually predict steeper price declines than downward sloping ones. Step 5 is calculating the profit target using the traditional measure rule. Draw a vertical line from the peak of the head down to the neckline. Subtract that exact dollar distance from the breakout price to establish your strict horizontal take-profit target. One exception: if a deep second trough creates a severely steep downward-sloping neckline, use the alternative method. Measure the vertical distance from the head down to the highest trough, point A. Subtract that distance from point A's price to set your target. Calculating this precise take-profit zone removes hope from the equation. You are relying entirely on a clear, mathematically derived risk-to-reward ratio. Step 6 is execution. You must wait for confirmation. Do not act when the price simply touches the neckline. Wait until a daily candle pierces and fully closes below the line. Shorting before the break is a trap. Jumping the gun leads to heavy losses. Once broken, expect a pullback. Price often curls back up to retest the neckline from below before resuming its downward trajectory. Finally, protect your capital. Place a hard stop-loss order slightly above the lower of the two troughs, or just above the neckline itself. If the price rallies past that point, the pattern is busted and you exit the trade immediately. Waiting for confirmation and enforcing strict stop-losses takes a theoretical chart pattern and turns it into a protected, actionable business decision. Let's review the complete checklist. 1. Spot the three peaks. 2. Check the volume for exhaustion. 3. Draw the neckline. 4. Calculate the target. And 5. Wait for the daily close to confirm the breakout. Now it's your turn. Open your charting software. Pull up a stock that has been on an extended bull run and scan the timeline. Look for the anatomy of a reversal. Patience and strict adherence to these mechanical rules separate emotional gamblers from calculated professional traders.